Picking undervalued stocks that can make you millions of rupees is a smart move by smart investors. Nearly every potential investor fantasizes about becoming a multi-billionaire via stock market investment. Whether you can make millions by investing in undervalued stocks depends on your intellectual prowess. In this video, we will explain to you how you can pick undervalued stocks through your investment in the stock market. People who trade stocks often have a strong desire to get rich. Stock trading has made a lot of money for many people. To be successful at stock investing, you need to work hard, keep going, and do a lot of research on the market. Stay until the end of this video because we will discuss the stock screener, how to use it, and some important steps to pick undervalued stocks that can be very helpful for you to make millions from the stock market. We often await sales to save money on large purchases. After all, a sale is the most efficient approach to saving money while buying costly things. Many investors exhibit this pattern of conduct as well. They put a lot of effort into looking for cheap stocks that are undervalued. When the market price of a stock is thought to be lower than the stock's intrinsic worth, we say the stock is undervalued. Such stock investments often provide substantial returns and help mitigate portfolio volatility. However, many investors' first concern is how to pick undervalued stocks. What is a stock screener and how does it work efficiently? Using a stock screener is the first step in picking undervalued stocks. A stock screener is a set of tools that lets investors quickly narrow their choices by searching through many firms based on criteria. Benjamin Graham, known as the father of value investing, developed one of the early stock screeners. He used several valuation indicators, such as the PE ratio, the debt-to-equity ratio, the dividend yield, etc., to pick undervalued stocks. Stock selection criteria of Benjamin Graham. A stock's price-to-earnings ratio (PE) should be less than the inverse yield of AAA corporate bonds and less than 40% of the 5-year PE average. A stock's dividend yield should be more than 2/3 of the yield on AAA corporate bonds. The market value of a company's shares should not exceed 2/3 of its book value, or net current assets. If a stock's debt-to-equity ratio is more than 1, it's a bad investment. The ratio of current assets to current liabilities should be greater than 2:1. The ratio of outstanding debt to net current assets should be below 2. Over the last decade, EPS growth rates have needed to be higher than 7%. You can't afford to have up to 2 years of negative profits in the previous 10 years, so be sure to check carefully for that. Benjamin Graham used this stock screener to find firms with a history of steady profitability, a healthy balance sheet, and a low value. Even though this was an excellent way to choose undervalued stocks in the 1930s and 1940s, stock screeners have changed to include more qualitative factors. Stock selection criteria of Warren Buffett. Warren Buffett, Graham's famous student, created one of the most recent stock screeners, considering factors other than price. The stock screener that Warren Buffett made is based on a few simple ideas from business, management, finance, and the stock market. The business must have a clear and concise business model, a consistent and predictable operating history, good long-term prospects, and a wide economic moat. Stocks should only be managed by leaders, not followers, who are trustworthy and open to the public. High return on equity, high earnings, stable and high margin of profit, and the use of discounted cash flow are all important financial indicators to look for in a stock. While thinking about the market, it's important to keep both greed and fear in mind and make prudent profit projections. With these and other lessons from Warren Buffett about money, it's clear that investors can rely on more than complex data to make good, long-term decisions. Important steps to pick undervalued stocks. Let's take a deeper look at the 3-step process of picking undervalued stocks and see how contemporary investors may profit from stock screeners and guiding principles. Step number 1, minimize the available stock options. You should eliminate businesses that do not meet the following criteria when choosing stocks based on value: poor earnings quality, diversion of cash flows and profits, governance issues. Some key metrics that can determine if a company's earnings are not very good are irregular depreciation charges, erratic earnings ratio, inconsistency between operating cash flow and profits. Seeing cases of insider trading can show cash flow, and profit diversion in the same way that seeing examples of frequent transactions between related parties can. Promoters who have pledged a large percentage of their shares are another kind of company that may be weeded out using these criteria. Successful businesses often have low borrowing levels and fewer promoter-held shares pledged. Since more information is now readily available to the public, it is much simpler to spot problems with corporate governance. If a stock's ESG, environmental, social, and governance or shareholder friendliness score has changed, it may be used to help determine whether or not it is a good value investment. By measuring depreciation as a percentage of EBIT, depreciation charges that need to be clarified can be eliminated. The PE ratio's lack of one-time gains or costs and the fact that it doesn't count irregular earnings make it a better way to compare things. The EBITDA ratio to operating cash flow is a good way to keep profits and operating cash flow from changing too much. The measure of purchase, sale, or supply of goods, services, or property to subsidiaries, common directors, etc. may help cut down on the number of related party transactions. The percentage of promoter shares pledged can be used to eliminate shares pledged by promoters. A shareholder friendliness score might not be needed if dividends are paid on time and stay the same. Even though the criteria for being left out aren't set in stone, they may help narrow down the list of stocks invested to a more manageable group of possibly underpriced options. Let's look at an example to see how the influence of irregular depreciation charges on a company's worth might be shown. Let's assume a car leasing firm has calculated the average age of the vehicles it provides leases for is 5 years. Thus, the value of the company's vehicles will decrease by 20% annually. Assuming that the leasing company owns 10,000 cars, each valued at 10 lakh, its total assets would be worth 1,000 crore rupees. And at 20%, the annual depreciation of its assets will be 200 crore rupees. Let's say there was a change in the company's leadership, and the new team decided to reevaluate the company's holdings. The company's new leaders have decided to double the time between replacing cars, from 5 years to 10 years. Because of this change, the depreciation rate will now be 10%. As a result, the company's yearly depreciation of its assets would be reduced to 100 billion rupees. The decreased depreciation should improve the company's bottom line. However, a temporary boost in profits will come at the expense of the business in the long run. Because of this, investing in the company's shares would be a waste of money. Therefore, those searching for undervalued stocks should avoid enterprises with convoluted financial statements, questionable accounting practices, or hidden cash flows. Step number 2, identifying quality stocks. After shortlisting stocks that could be undervalued, the next phase is to choose the most promising investments. By determining what makes a stock excellent is the first step in picking solid stocks. A high return on equity (ROE) is one of the most important metrics for evaluating a company's success. In the long run, if the firm has a good return on equity, it means that it is effectively putting its shareholders' money to work. A higher ROE could signify that a company is doing better than its competitors. Businesses that have generated a long-term return on equity of 15% or more in India, where profit rates are now relatively low, are seen as successful. For example, assume a company's return on equity is 15%. This means that the firm has generated 15 rupees in additional profit for every 100 rupees invested, thanks to the use of the equity at its disposal. If a firm can keep its return on equity (ROE) high across many market downturns and upturns, it bodes well for its long-term health and success. The formula to calculate ROE is ROE equals revenues minus expenses plus tax, divided by average total assets minus average total liabilities. This formula can determine how well a company makes money, which makes the return on equity a useful metric. Therefore, a higher return on equity (ROE) indicates higher quality profits for a corporation. Businesses with high rates of return on equity are in a position of strength in their industry. As a result, investors get a significant return on their investment. One can also wrongly think that only large-cap firms can produce high ROE values, but this is different. Many mid- and small-sized enterprises achieve returns on equity (ROE) of 15% or more. Before we move to the third and the last step, make sure to hit the thumbs up icon below to like this video. The third step, never pay too much for a value stock. Finding solid businesses that are currently trading at a discount is the third step to choosing an undervalued stock. A firm may not be good value investment even if it is well managed, produces high quality products, and has a solid reputation. A possible contributor to this is the company's relatively high share price. If the price of a share were to rise, it would require a large outlay of capital and expose the investor to more danger. The price-book ratio or PB ratio is one indicator that may be utilized to avoid paying too much for a stock. A stock is deemed pricey if its PB ratio is more than 1.5 times the average PB ratio of the sector. Investors can use this basic statistic to own in on the best deals in any market. Companies in the same industry may have quite different PB ratios. When looking at technology stocks in India, the PB ratio is 4 to 20 times that of the industry as a whole. By using the PB ratio to determine what constitutes an expensive and cheap company, value investors are protected from buying just the most talked about companies in any given market. In every market, picking inexpensive companies may be made easier by using a low relative PB ratio. Therefore, all you have to do to learn how a value fund selects undervalued stocks to invest in is enter the fund's top holdings into any stock screener. The results will reveal the fund management team's perspectives on identifying undervalued stocks. This was for today's video to guide you on how to pick undervalued stocks that can make you millions. Remember to subscribe to the channel and press the bell icon before leaving this video. Do you have any future plans for investment in undervalued stocks? In how many years do you want to see yourself as a millionaire? Tell us in the comment section below, because we value your feedback. We have also uploaded a video on the book The Psychology of Money on our channel, which can be very helpful to you for knowing all the secret tips to become rich in that book and how to become a millionaire in 2022. You can find the link to that video in the description below and in the card.